All right. Hey, VV Nation. So we're starting a little early. I know we're about 30 seconds before the market opens or before the Fed announcement comes. So I figured I would get us started here right now. Welcome to AMA Afternoon Market Action. My name is Patrick France, Senior Instructor here at VectorVest, and I will be your host for today's session. We have the Fed interest rate decision coming up in just a few minutes, or just a few seconds actually. So let's go ahead, switch over to that and see how the market reacts when the announcement comes out or when the decision comes out. So let's go ahead and switch that real quick. There we go. And as you can see, I am also here with my fellow colleague, Glenn Tompkins, right below me. He's pointing to the man that knows what he's talking about. So there you go. You can see that right there for you. Let me go ahead and get the chat pulled up because I'm missing it here. Awesome. All right. So right now, market took right off for a second, then pausing. So we're seeing some indecision going on in the market. Hey there, Jamie. He's pointing to he knows who's right. So he's pointing to who's right. Good morning or good afternoon, Martin, Jamie, Roger, Ben, Salt, Remen, Gemini, Ravi. Hello, good afternoon. Hopefully you all are doing well. Right now, we are seeing the market starting to take off a little bit. So everything seems to be going as planned. I haven't got any update quite yet on what the decision was, or the official decision that's coming in, but the markets seem to be reacting favorably. As always, we're going to be patient with it though, because one bar doesn't make a trend. We need to see, what happens come 2:30 when Jerome Powell actually speaks. 0.75 basis points, so markets are rallying off of that news. But as we've seen the last few times, the markets act drastically and we see a lot of volatility one way or the other until Powell comes on, and then that seems to put out the momentum we see in the market. So we're gonna have to be patient. Let's let this data really settle into the markets before we start making decisions from here. But 75 basis point hike is what it appears to be. We're seeing volatility dropping sharply here. We're seeing the markets rallying sharply. Let's go ahead, take a look at the major indices and see what those are doing right now as well. So starting off with the S&P 500. S&P 500 rallying sharply, seeing strong buying coming in right here on this current minute. We go to the next, the Dow, same situation. Breaking through some resistance we had here earlier at 327.25. And then looking at the NASDAQ also breaking through some major resistance here. Realistically, we had this level here. Got to find it. I guess we got to zoom back a little bit. Let's go ahead, zoom back a little bit. There we go. So we had resistance that got broken at 274, basically 275, and now breaking through the resistance at 276. So markets seem to be reacting favorably to what's going on. Now, let me go ahead. I have this. I'm all alone here today, so let me get everything set up for you guys. I do have the Fed decision or Powell's video ready to go. When he comes on, says it's supposed to start at 2 o'clock, but I don't see that kicking on quite yet. Let me go ahead and refresh this. So yeah, looks like they haven't started the stream, so therefore we got to be patient with that, but I will keep an eye on that. Maybe I'll check it in a little bit when we get a little closer to it. Reversal at 2:30 when Jay Powell speaks, easy money. Yeah, I mean, that could definitely be a very real possibility. Everybody's been talking about when he comes in that we will start to see some sort of verbiage stating a pivot or something around a pivot. And that's really what everybody's expecting to hear. So if he doesn't, or if he talks about how he's going to stick to their guns for right now, then we could see this rally that we're noticing on this current time frame starting to reverse, seeing the markets move lower. So we're going to be patient, wait to see how it plays out, but we're going to keep an eye on this and wait to get that stream pulled up for when it comes in. But good afternoon, everybody. Hopefully you guys are doing well. I know this is a little bit different than what we typically do. Started early so that way we can see that initial reaction. But Manju, Drew, glad to see you guys. Roger, as always, a pleasure. Hopefully you guys are doing well this afternoon. All right. What's wrong? Supposed to go down. Well, Jerome Powell hasn't come up yet, Haas, so be patient. There's still plenty of time in the market. This is just the initial reaction. There's probably going to be a lot more big swings higher and lower in the near future over the next course of the hour over the stream. So let's just be patient, wait. This is all algorithms going on. Can we play the reversal? I mean, if you want to. I know I've got some positions set up. I'm keeping an eye on them. We did get into DRV yesterday for our Trading for Charity event. Plus, we got into UVXY. So let's go ahead and pull those up just to take a quick look. I have a feeling UVXY is probably heading south right now, but we got to be patient. Yeah, UVXY pulling back. But once again, folks, Powell comes on at 2:30. That's where the real magic starts to happen. So that's why we're here right now, keeping an eye on this, being patient, waiting to see what happens. Don't overreact for the time being. So UVXY selling off for the time being. Let's go take a look at DRV. DRV, interestingly enough, pulling back as well. So let's get this straight. You're telling me the overall market or real estate is rallying currently because interest rates that are crushing the real estate market are going up. That doesn't seem to be too intuitive right there. So let's be patient with this one. Never seen Glenn so silent. I know, it's a nice change of pace for once, isn't it, Mark? All right, as always though, if you guys are just tuning in, make sure if you guys enjoy today's stream that you're smashing that like button, subscribing to the channel if you're not already subscribed. All of that helps us out, doesn't cost you a thing, and helps continue to grow the VV Nation community. So if you enjoy the VV Nation community, you want to see it continuing, you want to see it growing, make sure, as always, smash that like button, subscribe to the channel if you're not already subscribed. All right, if you didn't get into these yesterday, it's okay to get into the drop or wait. Let's be patient. Once again, patience, folks, patience. This is just the initial reactions where we're seeing a lot of algorithms really making the moves in the market. These aren't actual traders trading it. Everything is waiting until Powell talks. We're seeing the initial reaction, but I have a feeling we're going to see even more volatility kicking in the very near future, roughly in about 13 minutes or so. Or actually, 23 minutes or so. All right, let's see. Make sure I get everything all organized here. Appreciate that, Mash. Just seeing that one there. Crazy manipulation on the S&P options. Not surprised in the slightest there. All right, so let's go take a look. So DRV, we zoom out a little bit. DRV, we had this double bottom we were keeping an eye on yesterday. We talked about it a lot. Bounced off of that double bottom, gapped up higher here today, ran up nicely up to about 64.50. Now starting to pull back, but as long as it can stay above this high here, let's see where that is. Let me go ahead and get my cursor on here. 60.94. It looks like we're a little bit below that at the moment. So be careful with that one. But if we can get back above that, close above this 60.94, that would definitely be a positive sign. Chip, I like that comment. As a recovering FOMO addict, patience is key. Exactly. The initial reaction, you're going to have a lot of emotional traders jumping in right now. But that's why we're going to take it easy, slowly get into things here and wait for the Fed or wait for Powell to actually speak. And then we'll start getting a true sense of what or how the market's handling the news here. Jeff's coming in saying the critical dates, October CPI release on 11/10. CPI is Jay Powell's focus. Yeah, but that's going to impact that next rate hike, not this rate hike. So we'll have to be patient. Those are definitely going to be important times, but we have to really wait and see what Powell says and his message that he really tries to get through with today's press conference. All right, looking at UVXY. So UVXY was looking like, actually, now that Glenn's not here, I can get the best graph layout set up. There we go. Only 10 likes. I'm not even following it, Ben. So if there's only 10 likes, you guys know what to do. All right. But looking at UVXY, we were getting oversold based off stochastics, which we'll show right here. I can take off volume and the 20-day moving average volume. We see holding out, grossly oversold. We took a position in it yesterday. It's really not off too far from where we got into it yet. Only a few cents off. And yeah, right now we go zoom into a 1 day. The initial reaction was bearish, but it's consolidating here and potentially getting ready to turn around. We have some resistance found here right around 963. With this consolidation, if we break above that point, we could be seeing a new rally coming in. But once again, only about 20 more minutes or so before we have Powell speaking, and then that's where the real fireworks start to show. So we'll be patient, not overreact. I would say plummet is an emotional overreaction, Marie, to what we're seeing here so far. All right, let's go ahead, take a look. Going back to the VectorVest composite. Whoo-wee! Really big rally coming in. Seeing the markets continuing to push higher here. Looking at the S&P. Now the S&P is showing something a little bit different though. You had a big run coming up here. Now starting to stall out, pulling back over the last 10 minutes or so. Let's go look at the Dow. Same situation. So everything's consolidating after that big run. So we're seeing the markets taking it in, analyzing that data a little bit closer. And we're seeing less of that initial emotional reaction kicking in right now. NASDAQ coming back down below that support around 275. Let's see if things continue to follow suit here. All right. So let's go ahead and see if the interview or the press conference is started. Supposed to start at 2. It is now 2:12 and it is still not on. So let's go ahead, find another one. Give me a moment. Upcoming. All right, 2:15. I like that one a little bit better. What's up with Glenn? Hey, he's just happy he could be here right now. Glenn's currently experiencing some computer issues possibly. All right, so looking at the NASDAQ. Broke down below that support, rallying back now. Keep an eye on your volume though. Volume's still lighter than it has been relative to the most recent minutes traded here. Let's go look at the market. Market's continuing to rally overall. If we pull this up, the dashboard, let's see what we have on the dashboard here. I'm going to go ahead and get rid of some of this. So, here we go. Stocks bounce as Fed delivers fourth 75 basis point rate hike here. All right, so we got that news right there for us. Let's go ahead and look at advanced declines. Right now, 53% of stocks are up for the day. 37% of stocks are down for the day. 10% of stocks basically unchanged for the session. He looks like he needs some coffee is what he looks like. All right, so getting back into it. UVXY trying to break through, taking some time. Once again, we still got plenty of time to really see how the markets are taking the news here today. Needs bacon too? Yeah. Glenn, sir, would you please check DRV? Yeah, he'll get right on it for you, Ravi. All right. And as he's doing that, let's go ahead and get on to what we're taking a look at here today. Seeing the S&P 500 pulling back a little bit now, Volume still lower, so still not a whole lot to go off of. The main move was that initial reaction right at 2 o'clock. Huge volume coming in, but markets stalling out once again, waiting for the actual interview to start rather than just going off of what we're seeing right now. I think he speaks at 2:30. So yeah, he does speak at 2:30. I'm trying to make sure that we have everything ready to go. It's just me today. So therefore I'm controlling everything. So I want to make sure I have that interview ready to go. I want to make sure that everything is working. I want to check audio, make sure it's good for you guys, before he actually comes on. So that way, nobody's complaining about having audio issues or not being able to hear anything. So that should be starting any moment now. Let me check. So while I'm checking, what are your guys' initial thoughts? Let me know. I'm curious to hear about it. What are your guys' initial thoughts on the rate hike? Do you think we're going to start seeing some slowdown or some pivot mentioning? Do you think we're going to continue to push higher? What's your guys' initial reaction to it? Still not working right now. Budge under political pressure, you think? Push higher? Yeah, I like no pivot, so I'm seeing more saying that he's not going to back down. He's going to stick to his guns, more so than I am thinking that he's going to back down from rate hikes. So it'll be interesting. It'll definitely be interesting to see what he has to say today. But yeah, looking at the markets, just taking a breather, waiting until we start seeing actual usable information coming from the Fed himself. So going through QQQ, pulling back a little bit. UVXY, we've looked at that. DRV still pulling back right now. Even with what's going on, with rate hikes continuing to climb, with the housing market continuing to decline, DRV is pulling back right now. 10-year below 4% after Fed signal. Signals a potential policy change. Let's see. I saw an interesting news article the other day, or not really an article, more of a data set about how the markets react after the Fed mentions a pivot during a recession, and markets continue to decline typically after they mention that. So, everybody keeps putting all this weight on, he's going to mention something about pivoting, then the markets will take off. But historically, that doesn't tend to happen. So it's going to be interesting to see, today we may see some crazy news in the market. We may see some crazy movements in the market, but like we've seen in the past, whenever the Fed speaks, the markets move one way, the next day they tend to reverse, move the other way. So be patient with this one, folks, because, we're already in a significant decline. We got to see what moves or how things are going to be handled going forward, because it's becoming more and more dire as the months continue to go on. Talking heads on CNBC saying pivot announcement. I don't believe it. Yeah, Jeff. So a lot of what I've seen so far, the pivot announcement and the pivot talk has come from BlackRock starting those rumors, or at least a lot of people point towards BlackRock as stating that the Fed's going to talk about pivoting in this most recent or in this interview today. So a lot of ears are going to be focused on what he's going to say and waiting to hear that. Now, markets reacting favorably to an interest rate hike, which seems counterintuitive. But what happens, though, if they're acting favorably to the interest rate hike, so they've gotten 50% of what they expected to see here today, what happens if that other 50% doesn't happen? What do the markets do if Powell doesn't come in stating that, he sees a reversal in his policies in the near future. Interest rates are still well below the current inflation rate, and inflation is still extremely high. Now, there's been a lot of talk about, hey, maybe he should slow down. You guys have heard it here first. We've been talking about it for months where, maybe the Fed needs to slow down that rate hike policy, give it a few months, wait to see the effects that these rate hikes are having, and then make an adjustment from there if necessary. You're starting to see it. I saw, Elizabeth Warren, the letter she wrote from Congress to the Federal Reserve stating just that, just what we've been talking about over the last 3 to 6 months, that maybe the Fed should be waiting, taking a little bit of a pause to see the full effects of their rate hikes before continuing to hike more aggressively or hike even further from where we're at. But let's be patient though. We've got it about 10 more minutes before, 9.5 minutes roughly before they come on. So let's just be patient. Got 30% of my Iron Condor and SPY, got out of it. Hey, can't go broke taking profits, Marie. Well done. Let's see. Vols are... Hey, the Vols are looking pretty good, Rocky Top. I'm an Auburn fan, but I will root for the Vols whenever they're not playing Auburn. Now, the true question is, who ruined a program worse? The Harrison thing going on with Auburn or Lane Kiffin back in the day at Tennessee? All right, let me check, see if they're live yet. If the interview's starting. Still not. Come on, Yahoo Finance. Get your act together. All right. Just waiting. Still too early to discern a clear direction. Exactly. I completely agree, JSS. If we zoom out, we talked about, oh man, somebody had too much fun with this chart recently. Jeremy Pruitt at Tennessee. I forgot about him. But looking back at the markets, I talked about it in the video we did that we released on Monday for you guys, talking about all the major news that you got to be aware of. If you haven't watched it, it's a little late, but still, you can still get some use out of it here today. Looking at it though, we did have this support at 50.19 on the VectorVest composite. Double bottom bounced off of that, higher low leads to higher highs. We're getting that now. But where is some resistance we could expect to see the market slow down? Well, 54.19. Where are we at? 54.30 and the day hasn't closed. We tried getting above that resistance yesterday, failed to do so, came right back down, started moving lower up until that 2 o'clock time frame. So if we don't get any mentions of a pivot or, the Fed still keeps sticking with their hawkish tone, we could see this resistance continue to hold and seeing the market rejecting that start to move lower once again. All right, so that's really the main thing is, markets are setting up at a major inflection point. We could see if we break out from this resistance zone, we could see a huge run coming in, moving higher. But if we fail to hold above this 54.15 level, we could see the markets continue to decline. And that is a pretty steep drop that we got to go before we get down to that next support level. Once again, down here around the 50.20 level. Hey, Kevin, hopefully you're doing well. But instead of a call, whoops. Hate when that happens. Deion Sanders going to Auburn. Yeah, I like Cadillac Williams being there though. Big fan of Cadillac from the old school days. So I like him being there right now. Showing off Boyle's one. Hey, if only he was here today. Actually, he is. He's here with us in spirit, but he's here with us. All right, let me check. So let's do this. Let me go ahead. Get rid of this. Theater mode. There we go. How do I get rid of chat? Hide chat. Man, if only I just read. We put this on. Put it on full screen. There we go. Let me turn on the volume now. Let me toss on desktop audio. Can you guys hear it? Doesn't show that it's... Let me check. Any audio from there? All right, just bear with me for a moment. I got audio, but why is... Try and tell if it's just quiet. Oh, oh, is he coming? Hey, appreciate that, Vols. All right. All right, so I'm starting to get some audio. Let me turn this up a little bit. All right, how's the audio for you guys now? It seems a little quiet already, but it may just be because he's not already on there.
We'll be back again. Oh, sorry. One other thing. If you could also please silence your phone.
You guys can hear it?
Or anything else that might make noise, that would be really helpful. I will be back.
All right, type in a 1 if the audio is good for you. Type in a 2 into chat if the audio is not good for you. Let's start with that way. Yeah, I think the audio might just be low because nobody's up there yet. They only have one mic plugged in. Hey, thank you for that, Joe. Glad you could be here today. Okay, a lot of people coming in with 2s. Let's wait till he comes on, and then we'll adjust it from there. All right. Pull this up. All right, looking at the S&P 500, pulling back, came back down to retest that support, 385. Bouncing off as we speak, getting ready to start running here. Keep an eye on what Powell does with his glasses. I know, Drew, right? What are we going to see here today? Very low audio. That's because it looks like they've only got one mic hooked up and nobody's really talking yet. So it's not really getting the full audio sound quite yet. Also, if you guys are just tuning in and you haven't already, hit that like button to show your support for the channel. It doesn't cost you a thing and helps continue to grow this awesome community that we've built here over the last few years, the VV Nation community. So if you guys want to continue to see these live streams, continue to see all this amazing content week in and week out, continue to see more people growing into the VV Nation community, make sure, as always, smash that like button here. I'm coming in and out now. All right, we'll wait till he pops up on TV, then I'll pause it for right now. And wait till he shows up on camera, and then we'll cut to that. But taking a look at the markets. Dow, same situation. Pulled back. Now starting to come back to retest that resistance at 330. The Qs have resistance at 277. S&P has resistance at 388. Let's wait and see what he does here. Go and take a look at the VectorVest composite here. My sound has become muffled? I haven't changed anything to my sound. You guys shouldn't be hearing anything else other than me right now. Looking at the VectorVest composite, we blew through that level of resistance, continuing to climb. Let's go take a look at volatility. So volatility, this is going to be a key component to keep an eye on as well. 950 at that low. Breaking that as we speak. I look like Glenn? Yeah, I do look like Glenn. Thank you. Just the younger, handsomer, whiter version of Glenn. You haven't moved. Yeah, Fed raises 75 basis points. Look at that. Double bottom, possibly? All right, let's see the markets. Stalling out right at that resistance level, right at 230. It's almost as if somebody had this planned here. All right, here we go. Here's the man. Let's get it, VB Nation. Let me turn this on.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation.
Blaming others.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
Oh, come on. Get into the good stuff already.
With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
There we go,
Our
folks.
decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course, folks, until the job is done.
No pivot.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby.
DRV's back up to where we were pre-announcement.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi,
Everything
Howard Schneider with
saying
Reuters.
is indicating
Look,
he's
I'm
not
sure there's
backing
going to
down
be
anytime
tons
in
of
the near
confusion
future.
out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace.
So is he suggesting that maybe a 1% rate hike could be coming
monetary
next?
Policy, as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else,
So basically he's just stating that, yeah, there's some rumors about that, and we've talked about it, but that's not really important right now. And most likely we could even see higher rate hikes. So markets don't like indecision. Markets don't like confusion. Keep that in mind.
The federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick?
Nick Tamaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
All right. So
This is the question of does
Actually,
the
let's
policy
go
rate
this way.
need to get above the inflation rate? And I would say there are a range of views
Very-
on that. That's the classic Taylor principle view. But I would think you'd look
So,
more at
let's
a
kind of recap
forward,
what he's saying.
A forward-looking
So far,
measure
he
of
stated that
inflation to look at that.
you know,
But,
yes, he's addressing those
I
rumors
think
that
the
have come
answer
out
is
that we are
we'll
going to
wanna
see
get
Turner's
the
volume
policy
down.
rate to a level where it is
I just
where
did.
the real interest rate is
But
positive. We
so
will wanna
basically
do
what we're
that.
seeing so
I
far
do not think of it as the
is
as the
he's
single and
announcing
only
that
touchstone.
they're
I think you put some weight
they
on
could
that.
be
You also put
considering
some weight
a
on rates
change
across
in
the
or
curve.
pivot
Very few
in
people
policy
borrow
in the
at
next
the short
meeting
end
or
at the-
two.
at the federal
But
funds
he's
rate, for
also
example.
stating
So
that
households and
we could
businesses,
see
if
a
they're
higher
very,
rate hike
meaningfully positive
coming in
interest rates
over the
all
next
across the curve for them. Credit
next
spread-
week or
spreads
next
larger,
meeting or
so
two.
borrowing rates are significantly
So,
higher. I think
this
financial
is going to
conditions have
cause a
tightened
lot
quite a
of
bit.
uncertainty
So
in the markets.
I would look at that as an
And as
important
we've
feature.
talked
I'd
about
put
in the
some weight
past,
on it, but I wouldn't
markets
say
don't
it's-
like
it's
uncertainty.
It's something that
So
that
this
is the
isn't
single dominant
necessarily
thing
the
to look
greatest
at.
thing coming from,
follow up.
he
What
got asked
is
it by an
your
interviewer.
best assessment
He
or
didn't
the
make an
staff's best
announcement about it
assessment
in his
right now of the
actual
current rate of underlying
actual statement.
inflation?
So
I
be
don't have a
careful right
specific
now,
number for
folks.
you there. So there are many models.
There's a
that
lot of
look
mixed
at
signals
that.
coming
And,
from this
I
speech
mean,
so
one way
far.
to look at it is that it's a pretty stationary object, and that when inflation runs above that level for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley, New York
Politician,
Times.
right?
I
Get
wonder,
it?
do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do.
The same tools that he admitted to Congress that he doesn't even know will actually fix the issues of inflation. Keep that in mind.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them. but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint. Remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't.
Folks, did you just hear what he said? He said if we over-tighten, then we can use our tools to help the economy. What have Glenn and I been talking about week in and week out over the course of the last 6 months right here on AMA? We've stated the Fed knows something bigger is coming most likely, and therefore they need to keep raising rates, which is why they said it wasn't a recession, if you recall that debacle that they had, which is why they're justifying it to raise rates as high as they can, so that way they know something bigger is coming and they have more ability to move the rates back down. That was not something we wanted to hear from right now.
Thinking about them, but we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in September.
The Fed just basically, or Powell just stated, F your pivot. Excuse the language, but you guys get where he's going with that. He just told everybody who is hopeful on a pivot, you guys need to be quiet and sit down because I've got more work to do.
The clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand, a lot of sectors. You don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was much more carefully managed by the lenders. So it's a very different situation and doesn't present potential financial.
Which is why they're now trying to give out loans to people without having to check credit ratings and all of that.
Victoria.
He's right that the housing market is different this time around compared to 07, 08. But that's just because we're a little bit behind track from where we were in 07, 08 in the housing market.
Available workers. And I'm just curious, to what extent you do and don't draw a signal from that? So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still.
The average American got too much money, and corporate America didn't get enough of it. So we've got to make sure corporate America gets as much as they possibly can. That's what he's stating.
Keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth.
Let's blame
is that
wage
really
increases and not the PPP
right now?
loans that got forgiven and nobody was able to take.
The principal story of why prices are
got
going
forgiven
up.
And,
I don't think that.
Nobody checked that money where it was going.
I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%, core PCE inflation, which is a really good indicator of what's going on for us.
Do we have a strong economy? Let me know your guys' thoughts. Do we have a strong economy, or is it just because the dollar is so strong right now that we're seeing a less of an impact from the inflation here in the States?
That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy.
Hey, Jay, hopefully you're doing well.
Our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Janelle.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So
we're getting ethics talks again. You guys remember really back at the beginning of January when Powell came out and said, we're going to be closing all of our positions, all of our SPY calls that we had because it's unethical for us to trade based off the knowledge that we have and the impact we have on the market. So literally
at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that
so it's up now and running. So the markets are going to start rallying again because now they can get back into the markets.
We now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on
and avoid 50% haircuts like the average trader got?
I don't. So as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that, so that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said several meetings ago that the risk of doing too little.
Jerome Powell just turned into Forrest Gump. That's all I've got to say about that.
That risk assessment has changed a little bit.
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten. And we don't want to, we want to get this exactly right. But if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road, and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it. You have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thanks, Chris. Rugaber.
69 girls.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? there's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
So we've gone from stating, well, maybe next month or next meeting we'll start to talk about a pivot to we're going to be doing this for quite a while started off saying there's no change in pace. We're going to continue to push on ahead. Then he stated, well, we may be considering pivoting and talking about pivoting next meeting or two to we've still got a long ways to go. So we have flip-flopped multiple times over the course of this 30-minute interview so far that we've seen. Folks,
of interest rates that we think is
I mean, if this doesn't say I don't know what I'm doing at my job, I don't know what else will. He keeps flip-flopping. He's trying to give a dovish tone, but at the same time, he knows that he has to say what he's doing, or else he could be lying, and that could cause a whole lot of other issues.
And that's been the pattern.
I mean,
I
this
would have
is
little confidence that the forecast.
This is sad to watch, folks.
Today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say.
There's no pattern there. So everything that we've been doing has not helped at all. But we're going to keep doing it anyways.
That we're thinking about.
What's the definition of insanity again? Can somebody let me know in the chat? What is the definition of insanity?
Is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year. But I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels.
Because consumer debt just hit an all-time high of $960 billion. And personal savings, consumer savings is down to only 3.1%.
They're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
You know what? I just came up with the greatest idea to fix all the inflation that we've had over the course of the global pandemic and everything. How about everybody who took a PPP loan out is non-forgivable now? Reverse your statements on that earlier and make everybody that took out a PPP loan have to pay it back. How about that? All of a sudden, inflation's fixed. Money supply is under control. Inflation's fixed. We're off to a better place at that point.
But we know what our objective is, and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and
Food inflation
I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
There you go, folks. We're going to end it on that. All right, so to address RPAD, PPP money is gone. More than half the service industry would go belly up if they would have paid back their PPP loan. It's not a loan. You can't use that word loan because they didn't pay it back. A loan you pay back, folks. This was a handout, a government handout, and you look at where all that money came or went to, it went into the major corporations. Now, there were some smaller companies that used it for the proper reasonings, but if it's a loan, you pay back a loan. I mean, that's like saying my house loan, I don't have to pay back. I took a loan out on my house, so what? I don't have to pay it back? It gets forgiven? No, a loan you have to pay back. You wonder why inflation is what it is? It's not because of the few $100 everybody got and the stimulus checks. It's because of the abuse that the elite really took advantage of with the PPP loans and knew that they would be forgiven and just recklessly spent it, and all the printing that came from that specific aspect of the relief plan that they came up with. So whatever they want to say is what it is. That's facts right there. All right. Now, on that note, let's take a look at what the market's doing, and then we'll start getting ready to wrap things up. Looking at the markets. Markets coming back down, continuing to landslide. SPY for the spider or the S&P 500 try to get a little relief, now heading lower again. Dow tried to get a little relief, now heading lower again. NASDAQ getting hit the hardest. Let's go ahead and look at the 1 day. Tried getting a relief rally, got right up to resistance, and then now hitting a new low. All right, so on that, that's going to do it for me today. Thank you all for tuning in. I don't even know how many likes we got. I don't have it pulled up right now. Let me take a look real quick, see where we're at on that one. Give me a moment. We've got wow. I did not realize we had well over 200 people here. Only 114 likes. Hey, can we see 150? Or let's get we are 120 right now. Can we get 30 more likes by the end of the stream? Let me wind things down. Let's see if we can get 30 more of you guys who are enjoying yourselves, who have been enjoying the commentary as we go through this. You know, once again, we're not just some talking heads on TV. We're retail investors just like you are. This is giving you a real life perspective and not just what the major news media wants you to hear. So I apologize if I offended anybody today. But If facts offend you, I'm sorry, is what it is. So on that note, thank you all for tuning in here today. I hope you enjoyed yourself. As always, if you're brand new to the channel, make sure to hit that subscribe button because we do have our Trading for Charity event going on right now where we're raising money for Levine Children's Hospital while also doing some live trading every Tuesday and Friday at noon Eastern. So if you're new here, want to see some live trading, some day trading, and help support a good cause and help raise money for Levine Children's Hospital, make sure to come hang out with me. Once again, right here on our YouTube channel at at noon Eastern on Tuesdays and Fridays every single week. And the last week will be the very first week of December. So also we do have mobile coaching stream coming out tomorrow at 11 a.m. Eastern. We don't have training Thursdays, so there is that, but we do have our mobile coaching stream tomorrow at 11 a.m. Eastern. So I look forward to seeing you guys there as well. So on that, getting into it, there we go. Thank you all for coming out and hanging out with us today. I hope you guys enjoyed the commentary. Hope it helped you guys out a little bit. Tuesdays and Fridays, Bill. Tuesdays and Fridays. Hopefully it helped you guys out here a little bit. I know some of the trades that we got into are looking still pretty good right now. We got into DRV yesterday for our Trading for Charity event. We got into UVXY yesterday as well. Those seem to be up nicely for the time being. Also, give a round of applause for our co-host Glenn today. He held that pose the whole entire time Jerome was talking. So big shout out to him for that one as well. So on that note, folks, thank you very much for hanging out with me today. Have a great rest of your day. Be safe out there. Take care. And until next time, toodles.